Hi guys, and welcome to the Daily Audicity with me, your host, Simon from Audicity. This was the show that was previously Smart Talk, but the name never really stuck with me. It was always supposed to be a placeholder. I quite like the Daily Audicity. It's got that ring of like the audacity of it, or the Audacity, and it's the company as well, so I think I'm going to stick with this one. I hope you're enjoying the shows and the series so far, and if you are, please like and please subscribe, and we'll continue to give you as much content as we possibly can. Today's show is all about the congressional hearing with the big banks and JP Morgan, as in Jamie Dimon, doing his usual tricks of slating for manipulative factors and all the rest of things. We all know Jamie Dimon's track record with Bitcoin. In the past, he was absolutely slating it, while it was proven on the back end of it that different offices that were under JP Morgan were buying up when people were selling it. And JP Morgan have a track record of this across all of the boards. So they got fined for rigging the VIX, they got fined for rigging the metals markets, they get fined for breaching sanctions, breaking AML rules all the time. They're a massive player in the global banking, which I completely agree with, but they're not exactly the most transparent and honest player. But I suppose that they're the biggest player because they're not the most transparent and honest player. So what happened this week is we've had a lot of congressional hearings around sort of Bitcoin, not Bitcoin in itself, but crypto stablecoins. And a lot of this has been triggered by the algorithmic stablecoin terror just going to absolute zero because of a run on it, which it happened, it's in the past now. It's not one of those things that it's just crypto, and the big players didn't really get hurt by it, but the retail players got hurt a lot by it. And South Korea have issued an arrest warrant for, I can never say this right, but Do-Won. I never pronounce it right, but they've issued an arrest warrant for him, and Binance have actually now started to put warnings on the trading of those tokens, just to say that they are absolutely not responsible for it. So this has been a direct reaction to what happened with Terra. It's unfortunate that it happened, but it's just one of those things. Algorithmic stablecoins need some work, and I think any stablecoin that's maintained by a free floating of decentralized assets is going to need some work, because you can't actually guarantee it. It's like projects investing in other projects for returns. You're then relying on other projects' returns for your returns, and it's out of your hands. Algorithmic stablecoins work in the same way. They're great if they've got actual capital reserves and they maintain the peg based on currencies and FX markets. But until they've actually got those capital reserves or access to credit, which is the important thing that we're missing in crypto on a whole, then they're still going to be a little bit dicey, because without access to credit, they've only got the liquid assets to back them up, and when there is runs on them, they can't actually do much about it. In Congress this week, Jamie Dimon said that Bitcoin was a Ponzi and, steer clear and all the rest of it. Now, he's done this before. We've all seen it before. But on top of everything else that's going on with Terra and lots of other hacks and lots of other incidents, it comes at an unfortunate time. Now, we can look at this unfortunate timing as, okay, it's just an absolute coincidence. But to me now, there seems to be a lot of coincidences that are lining up. So the crash on Terra, the crash in Bitcoin, all of this stuff seems to be lining up in sort of tandem with the whole topic of CBDCs and banks issuing their own stablecoins. So whether or not they're just trying to reallocate capital from decentralized markets to more centralized markets so they can actually gain on that, I don't know. But whenever this sort of news starts to compound, I become very skeptical on how confident I am on the people issuing the news. And I'm not confident at all on it. So I actually think at the moment there is a lot of manipulation in the markets coming from the very biggest players in financials to the very biggest players in media to the very biggest players and regulators. There seems to be a lot of free passes going around, and there seems to be a lot of support for the banks and an attack on decentralization as a whole, because the attacks are coming on decentralized blockchains and they're not really coming on permission blockchains. And I think this is all a ploy to move money from decentralized applications and move it into more centralized applications. Now, these things can completely coexist, and I think it's imperative that crypto stays decentralized and centralized. We need centralized regulations. We need the rules around how you convert crypto into money. We need the rules around how crypto is advertised, how crypto is maintained in the markets. So we can't have this continuation of people attacking particular public open blockchains that directly affects investors, because when this stuff happens in the actual traditional markets, there is a lot of penalties and a lot of fines and a lot of, you'll hear about Elon Musk being fined for manipulating the markets when he says that he can take Tesla private at however much a share. That obviously caused a massive uproar in the market. It was a factual statement, and the people were lined up to actually back that statement. Because he made the announcement publicly, he was fined for manipulating the markets. And this happens all the time in markets, and there is a lot of fines. JP Morgan, get fined lots for manipulating metal markets, manipulating money markets. It's just one of those things. Now, great, but for retail investors that have actually put their own hard-earned money into it, there's no investor protection whatsoever, and it's actually terrible. And it should be frowned upon. And they're sat there in Congress, and they're allowing it to happen, and they're sat there in the open markets, and they're allowing it to happen. We've all seen what happened with XRP after the SEC, nailed an absolute rinser on Ripple for selling securities. I think it wiped like 14 or 15 billion off the market in a day. If that happened in a traditional company in the stock market, there would be some serious repercussions for that, but there is no repercussions because there's no regulations around crypto. It's not a Ponzi. It's just young, and it's volatile, and it's got no access to credit. And it's decentralized, which they don't like. Governments, banks, all the rest of it are not going to like products that they do not control. And they cannot control them. At the moment, they can control them. It's got no access to credit, and it's got no access to reserve liquidity. So, it doesn't take a lot to move these markets, because if everything that's just floating on the exchange is how the price is determined, it's not going to really take a lot to move a price. But when it's got access to capital, and when they've got their own capital on the line, it'll be a very different story. Now, at the moment, they haven't got their own capital on the line, but they have got institutional clients that are interested. So whether or not, they are going to get involved in crypto because people are demanding it. So the banks are going to have to start to find ways to list the big ones, or use brokers or dealers to give their institutional clients access to this technology. Do they want it at a much cheaper price? So, they stand to gain more as they're entering the market. Has this been a plea for the last 2 years, slowing everything down? Was December just an absolute massive institutional pump of crypto with very little money to give it a facade of a price? And this is what none of us can know, because there is no protections in the market. Be very careful out there at the moment. Be very careful of listening to what people say, and just do your own thing, but do it within your own means. And we all hear the stories of, invest what you can lose to afford, and no one can actually afford to lose anything. So just be very careful with what you look at and what you listen to and who you listen to, and watch what they do and don't listen to what they say. It's an old proverb, but it is very true, because in the background, there is a lot more going on than what you can see in the foreground. And all of these people never, ever, ever say anything without a reason. And the reason is not to protect investors, because that is not their end goal. None of their goals are to protect their customers. They just want to make as much money as possible, because that's what attracts new money into them. If they're performing and their portfolios are performing incredibly well, then that's all they care about. We need to start to actually get formulated regulations. We need investor protections, and that includes limiting what these big influential people can say publicly. I hope you're enjoying the show. I hope you like the new name. If you don't like the new name, let me know in the comments, and we can work on something else. So take care, please like, please subscribe, and please share with your friends. We'll speak to you soon. Bye.